Good afternoon, everyone. I think that's the time, to start our webinar session today. Thank you very much, everyone, for joining. Just to briefly introduce myself, I am your account manager looking after our regional UK business here at Bloomberg in EMEA headquarters in London, and I'm also covering our crown dependencies. So today, we have invited you for this exciting webinar, and we're delighted that you managed to join this. So the topic of our discussion today is energy transition, investment outlook for oil majors versus clean energy. We have a number of great speakers today. So our senior clean energy analyst, Barnett, senior oil and gas analyst, Salih Ilmaz, and Patricio Alvarez, who is our gas and utilities analyst from our Bloomberg Intelligence team. And we also have Emma Coker on board, who is our BNEF Bloomberg New Energy Finance specialist focusing on carbon markets. So in terms of the agenda, we're going to explore insights into the topic of energy transition and how this will be affecting the markets in the future. And at the end of the session, we're going to have a Q&A time. So feel free to post your questions either into the chat here in the webinar room, or you can also send me a side IB, and we will discuss those questions at the end of the webinar. So at this stage, I think I will pass this over to our Bloomberg Intelligence team. Salih, you're welcome to join and start. Thank you.
Thank you very much, Elena. Hi, everyone. Hope everybody is doing well. My name is Salih Yilmaz. I am, as Elena said, one of the oil and gas analysts for Bloomberg Intelligence, and I am based in Dubai. It's great to be joining you here today. So I cover companies like Saudi Aramco and still some of the European names such as Repsol and OMV. But today, I'd like to talk to you about some of the general trends on energy transition by some of the larger majors to begin with. And then I think later on in the discussion, we will talk about some of the national oil companies like Saudi Aramco and ADNOC as well. So these, perhaps on the next slide, Rob, if you can go on the first slide. So as you can see, when we look at some of the major European oil majors, and we also have the Exxon and Chevron, the US majors, on here as well on the chart on the left. We know that these companies are increasing their transition-related spending. In 2023, the EU majors are expected to have between 10 to 20% of their total capital outlay geared towards transition, and this number is expected to keep rising. I mean, our core scenario in BI is for this number to reach 50% or more by 2030. But I mean, I should say that there are obviously differing opinions on this. We actually recently just ran a survey where the consensus seems to be a little bit more cautious than our core scenario, and I think the majority are expecting this to only happen perhaps by 2035, or in some cases even later. Also on this chart, very briefly, actually on the same slide, please. There's a clear difference, as you can tell, between the US majors and the US one and the European ones. European ones, clearly, a bigger chunk of their total capex is geared towards transition, and this has been the case for the last few years. US ones a little bit less, between 5 to 10%, and this is relatively new for them. I mean, the last few years they've actually tried to catch up a little bit. Before then, it was a much smaller number, but still lower than the European peers. So on the chart on the right, you can see that a big portion of this transition spending is earmarked for actually increasing renewable power generation capacity, which Patricio will be talking about a little bit more later on as well. We are seeing this grow steadily, and we do expect it to continue. And then, of course, some of these oil majors are starting from a lower base of power generation capacity, but we'll keep growing it, and I think they will become more important players in this power generation space. And, you know, we're talking about energy transition, and we will continue to do so in this hour. There is no one template for energy transition for these companies, and every company is taking a different approach. And we don't really know which one is the best and which strategy will pay off the most in the long run. But we can, I think, go on to talk about kind of some of the divergence in what these companies are doing later on in the discussion. So on the second slide, I think the one good thing for some of these majors globally is that they have the opportunity to be increasing spending, even though they are doing this pretty slowly, we would argue. And as you can see, their earnings performance has been very strong, their profitability, cash flow generation, as just their legacy oil and gas business is doing really well with benchmark hydrocarbon pricing still pretty elevated. But we should know that, I mean, 2022 was an extraordinary year. This year, not so much. But you can see in the chart that this year and next year are not going to be as strong, but still very elevated levels. So, so they are generating a lot of cash, but the priority remains capital discipline. The priority remains shareholder returns, more dividends, more buybacks. And you can see on the right-hand side that the return on average capital employed for these companies are surging. So I think eventually we will see, despite perhaps the focus not exactly being on higher spending and higher spending for the next couple of years, as the longer they have better profitability, the more we can expect them to increase their spending eventually. And lastly, on the last slide, we can actually, again, I mean, I briefly mentioned the divergence and the difference between the US majors and European majors. When we look at the valuation, it is also reflected in their valuations as well. European majors, I mean, are almost being punished for perhaps more green spending and more ambitious decarbonization targets. I mean, in some cases, the US majors are valued at twice as much as some of the European peers. But I mean, we see potential kind of narrowing of this gap in the near future. We are seeing that the energy transition strategies of some of these European majors are going through some moderation and perhaps a little bit of a backing off of some of the very ambitious targets that we saw from some of these companies, which might be welcomed by investors in this space. And I should also say on the right-hand side on the chart, energy is the lowest valued sector in the S&P 500. It still remains way below historical averages, these valuations, but we think that this could be up for some normalization as well. I mean, it's a tight and tightening oil market. Oil prices are rising, and the discounted valuation is perhaps becoming a little bit hard to justify, with investor sentiment seemingly slowly improving as the market is seeing the generous dividends, buybacks, and elevated free cash flow yields for these companies. So that's it from me. I'm sure we'll go on to talk about a little bit more in the discussion section, but that's it from me, and I'll pass it on to Patricio now.
Yep. Oh. Hello, everybody. My name is Patricio Alvarez. I am the European Utilities Analyst for Bloomberg Intelligence. And I'm just going to give a brief summary or sort of the state of what the outlook is for European utilities and their spending in the green transition. Next slide, please. So I think a good place to start is to see how valuation multiples have performed over the past 12 to 18 months for European utilities. So that chart at the very bottom shows that the stock 600 utilities index has somewhat flatlined at the very bottom. It hasn't really changed. While we see that other players within the sub-index, such as Ørsted, EDPR, and SSE, have really seen their valuations sink as interest rates have risen. So we see on the the white line has increased from the very bottom in 2020. So that's the 10-year US bond yield, generic bond yield, increasing more than fivefold throughout September of 2023, and that kind of tells a story of where or how this can impact renewable investments. If you look at the individual players such as Ørsted, for example, that company is increasingly exposed to offshore headwinds, meaning that the company is heavily concentrated in the offshore wind space, where supply chain bottlenecks and increases in the cost of capital have seen the value of its assets decline quite significantly, with which led to significant impairments announced in August. If you look at the second line below the blue one, that's EDPR, which is a Portuguese renewable power developer that has a bit of a more diversified portfolio between onshore and solar. It has operations in the US, in Europe, and in Asia as well. So you can see a little bit of a less dramatic sort of pullback there. And finally, you see SSC, which is the line that you can barely see there below EDPR. That's a company that has both regulated network assets and also renewable power. So you can see sort of the different degrees of how this period of higher interest rates is already impact or will impact investments in the energy transition. So can we go to the next slide, please? Okay, so diving into, I think, one of the most pressing topics for utilities at this moment is going into the offshore headwinds or the challenges that companies are seeing in this space. So why is offshore wind sort of in a bit of a pickle or a prolonged sort of pickle? Because that's mainly because of three factors. One is that the nature of offshore wind that has longer build time, so meaning that taking a project from its inception to its completion can take up to 10 years, with the period between a project being awarded and actually the start of the construction taking about 4 years, posing some risk for developers, meaning that inflation can hike up the cost of development and equipment, while the developers already signed those projects at fixed prices. And this has crimped the returns not only for Ørsted, but for other developers, including the likes of oil majors such as VP and Shell, who have also pulled back from select projects in the US. And well, going into the chart, I think it's a good way to see it is taking what's on the left. The chart on the left shows BNEF's LCOE analysis, which implies that the increase in development costs for offshore wind, costs went up from about $76 per megawatt from 2021 up to almost $150 per megawatt in 2023, and they're only expected to decrease to around 120 by 2029. So that really sets out the stage or sets the stage for prolonged headwinds in offshore wind, just because the cost of capital is higher and the lead times are much longer relative to other technologies such as onshore wind and solar, which you can see on the chart do have a little spike in 2023 in terms of cost, but after that, it's expected that the downtrend in cost continues. And on the chart on the right, that's the other point for let's say for an expected recovery in the sector that or a supportive factor is that interest rates are expected to peak by the end of this year and decline by over 80 basis points through the end of 2024. So that will be an alleviating factor for the sector as well. Next slide, please. Going more into what happened at Ørsted, and I think it's a good sort of bellwether for the sector as well. As I mentioned previously, these companies exposed to valuation risk or impairment risk on the projects that it's about to build, just because it has signed power price agreements or CFDs at fixed prices, and since it signed those contracts until it actually begins construction of these projects, which is called a final investment decision, the increase in cost is not being reflected in that fixed price. And so far, the company has announced that 3 projects in the US are very much exposed to these effects of the increase in cost of capital, increase in borrowing costs, and also the supply chain bottlenecks that cause delays. And obviously, that also impacts the value of the assets. And on the right side, that chart right there, what we try and expose is that Ørsted has already delivered significant growth over the past 5 years. Before 2022, the company delivered a compound annual growth rate of around 16%, which is in line with its longer-term goal. But we see its longer-term goal as increasingly unattainable. And that's just because the company, by losing out or by delaying the final investment decisions this year, that is very much likely to push its capacity targets beyond 2020, beyond 2030. The company aims to install about 28 gigawatts of offshore wind by 2030, but just given the sheer delays that we've experienced since 2021 and 2022, we expect that to shift back by about 2 years. Next slide, please. And finally, just as a summary, and then we'll open, I guess at the very end, we can open up for discussion in terms of technologies, but what we're seeing for European utilities is that capital allocation is shifting, and it's somewhat decelerating into renewable power investments. On the left, you can see that major integrated companies such as Iberdrola, Enel, and EDP, well, mostly, sorry, just Iberdrola and Enel, which are the sort of the clean energy super majors within the European utility space, those companies have actually decreased their capacity addition targets for the next 3 years, from Iberdrola from 5 to about 4, and Enel from 6 to about 4 as well. And that's mainly because of the rise in interest rates. Most of the utilities, or let's say utilities in general, aim to have a high share of contracted revenue, either from regulated assets or from power purchase agreements with fixed pricing. So that means that these companies don't have a lot of levers to hedge against inflation, such as oil majors, which can capture the benefit of the oil prices. Utilities very much don't have that hedge, and that's why we're seeing the investments in renewables actually slow down for the next 3 years, with the exception of EDP. Although EDP recently made a capital increase of about $1 billion just to cover the inflation cost of its renewable deployment plan. And I'd also flag that RWE is another outlier because that company has a net positive cash position and will probably increase its renewable targets for the next 3 years. And on the right side, just as a summary, or just to summarize, to bring it all home, it's you can see that capex within the European Utilities Index is expected to grow about 20% in 2023, but that's mainly to combat or to offset the increases in inflation. Capacity targets have not changed, and earnings momentum has not changed very much versus 2022 either. So this very much paints a bit of a bleaker picture in terms of what the investment momentum in the energy transition will be, especially within European utilities, which so far have been sort of the ones at the forefront of the energy transition. And with that, I'll pass it on to Rob. Oh, sorry, to Emma.
No worries at all, thank you. So I'm just going to give a bit of a flavour around what's been going on in European carbon markets and how those factors we've just been talking about have played out. Just very briefly, I sit in BloombergNEF. We're part of the research arm of Bloomberg that looks at the energy transition more broadly. So what's been going on with carbon? In fact, carbon's actually settled down a bit. The average price year to date is around 88 euros per tonne. You can see in the purple line, we've actually lost a load of the volatility that we were seeing last year, in part because of the reaction to the energy crisis. Now, the thing about carbon is it has a lot of drivers. So it's impacted by exactly the factors we were just talking about. It's impacted by cost of carry, interest rates, decarbonisation. So I'm just going to touch on a few of the big factors that we've seen kind of decrease this volatility and actually keep these prices pretty steady in the mid to late 80s. So if we first look at power sector, so what we've seen on the next slide is renewables are back in force. And so this is a chart showing monthly power emissions. Power emissions in the EU have come significantly down. We've seen the reversal of the coal units that were brought online in reaction to the war in Ukraine. Generation itself is down around 5% year on year. Emissions are forecast to be down this year around 18% from BNEF. And now that's in large part because of the recovery of renewables. We described last year as a bit of a perfect storm. We had obviously the reduction in Russian pipeline gas, but we also had a pretty terrible year for renewables. Hydro was down, nuclear was offline, wind had a pretty bad year in terms of generation. So what we're seeing is that flip now. What we're seeing is recovery in hydro is around 36% up year on year, and French nuclear availability is sitting at around 73%, whereas last year at times we were sitting more in the kind of low to mid 50%. And so what that translates to is lower power sector emissions. The reason we highlight this for carbon is because the power sector is the bulk of the emissions covered under the scheme, but obviously alongside renewables. Now, not only renewables being back in force, but what we've seen is a significant decline in the gas price. So next slide, please. One of the key decarbonisation factors, unfortunately, sorry, this slide isn't quite showing what it should. This is the slide we have trouble with a lot, so apologies. But effectively, this is the fuel switching price. And now, if it was displaying, what you would have seen is the fuel switch price average last year was around 296 euros per tonne. Now, comparative to our European carbon price, which at its max had 100, is nowhere near the kind of nearly 300 we saw that would have been necessary to switch from coal to gas. Now, the average this year has plummeted. It's sitting at around 70, which means we're back in fuel switch range, which means it's economic for generators to switch from coal to gas. Obviously, again, that decreases emissions, decreasing the need for compliance entities to buy European carbon allowances. Now, we can't talk about the carbon market if we don't talk about the Repower EU plan. So next slide, please. This is the plan effectively to get Europe away from Russian pipeline gas. Now, the plan agreed from the European Commission to generate 20 billion from the revenue that is generated by auctioning carbon allowances. Now, in order to do that, they decided to raid allowances from between 2027 and 2030 that were going to be auctioned for member states and bring them forward to the next couple of years. They also agreed to reallocate some of the innovation fund spending, which is effectively generated from selling allowances also. What this means is this is incredibly bearish for the near-term carbon price. We're effectively upping the allowances in the market for the next couple of years in order to generate that monetary target. But what that also means is on the flip side, we're taking allowances away from the latter end of the decade. Now, this is pretty significant because at the same time that this plan was being agreed, we also saw European lawmakers pass probably the most substantial climate law that they have in a long time, where they effectively decided to use the European carbon market as their main mechanism to achieve net zero. And so what they did was up the target at which the sector needs to decline in order to achieve emissions reductions. So entities within the EU ETS now have to achieve a 62% reduction in emissions by 2030 relative to 2005. And that's in order to get Europe on track with their Fit for 55 goal. Now, to do this, what they're doing is effectively declining the cap every year, which means less and less allowances will be available. That will push up the price and therefore incentivizing decarbonisation, which will be necessary to stay within the cap. Now, if we're already doing that and we're raiding allowances from the latter end, ineffectively to support the transition away from Russian gas now, what we've done is we've squeezed those later end years even further. And so just lastly, before we open it up or go to Rob, what this means for our forecasts. Now, I can't give away any spoilers. We're actually updating this for 2H. It will be out on Monday. But what you can see here is the general trajectory, which is in the next few years, we barely average just under 100 euros per tonne, but we climb significantly in those latter years. So 2H forecast might slightly reduce this, but effectively we're sitting kind of mid 150s, mid 160s by 2030. And what that means is the carbon price will therefore be able to drive the significant decarbonisation that's needed in order for the EU to achieve their climate targets. Now, one big thing to maybe also inform the discussion we're going to have is The bulk of the reductions we're expecting to happen in terms of decarbonisation out to 2030 is still the power sector. So we're really expecting the power sector to do the bulk of the decarbonisation through the likes of wind and solar. So the cost of carry issues, the high interest rate issues, the permitting issues, these are all incredibly critical for the EU to be able to achieve these targets. Industrial decarbonisation does start to ramp up in the final years in the likes of CCS and cement, but it's on a much smaller scale and needs more commercialisation than the power sector. And with that, I'll hand over to Rob.
Thank you, Emma. I do apologize for that slide. One of these days, I'm going to learn how to use PowerPoint correctly. I promise that Emma did not give me a blank slide like the one I showed you. Okay, so just quickly, let me observe that we do have the global team here. We've got Sally over in Dubai. We've got Emma, Patricio, there in London. I'm sitting in Miami at the moment. The energy transition is a global story. And I think that, you know, no matter where you're sitting, we can see this incredible wave of change that's occurring. This is just the past of wind and solar additions at the global level. I won't give you BNEF's forecast. I won't tell you what I think it's going to be, but just let your mind extrapolate. And so we're in this world that is just changing so quickly. And there's so many ways that you could think about it from an investment perspective. If you want to gain exposure to this theme, you know, certainly wind and solar companies are part of the energy transition. You've got the carbon markets that Emma was just talking about. You've got utilities, which are doing all kinds of things in the energy transition space, including deploying wind and solar. And I wouldn't count the oil companies out. As Sally mentioned, a number of the energy majors are participating by investing in wind and solar and doing all sorts of other things. So this is a complex theme, and there's multiple ways to think about, you know, where it's at, which part of the value chain you really want to be in. And so with that in mind, you know, we kind of heard from Patricio and Solly about this idea of valuations in their space. And so I want to do the same just on solar real quickly. Blue line here is the median EV/EBITDA multiple over the past few years for the companies in our global solar theme basket. And so we've seen a big pullback. That the median company in our solar theme basket's trading for a 9x EV/EBITDA multiple right now. The market, by the way, is around 11x. So these companies are at a discount to sort of the average stock that's out there. And as Solly pointed out, the oil companies are kind of at the bottom of the stack. So the industry is almost wrestling with this idea where you've seen solar companies be growth stocks. A year ago, they had a 16x EBITDA multiple. Very different landscape. They've trended down, and so I guess the question is: are they more like the oil companies out there, and sort of is that the right valuation that they should be trading at? Or are these growth stocks that you just have this hockey stick of investment that's occurring out there? And so I think the market's going to decide. We're not going to tell you what we think the answer is. We're not allowed to, in fact. But I think that it's a very exciting time in the space. And you know, if you set aside kind of the valuation perspective, what I would say is on the wind and solar side, the fundamentals look reasonably good. I mean, top line growth looks like it's going to be pretty strong, even with the higher interest rates that Patricio mentioned. You know, these industries are growing fast. You know, maybe is the solar industry going to grow at 50% or 40%? I don't know, but it's a really big number either way, even if you've got some headwind from the interest rate pulling you back a little bit from what you would have been otherwise. And so strong top line growth. We think that the best players are actually profitable. So, you know, the world has seen growth industries go out there and just burn a ton of cash as they grow. The high quality names in both the solar space and the wind space are not torching cash as they burn. They haven't torched in the past. We don't think they're going to start doing that. And so I think there's a compelling narrative here. Definitely reach out to me or anyone else on the team if you want to talk more about wind and solar specifically and how it fits with the energy transition. But with that, I'm going to stop sharing my slides, and we're going to have a bit of a discussion here amongst the group on the factors that really play into this big macro theme. And the first thing I would love to hear from the group before we're also going to have some commentary from Elena. She's monitoring the chat, so any questions you have, pop them in. We'll try to get to them. But I'm going to ask a few questions that are on my mind. And so, Emma, I'm going to come to you first. And I'm always wrestling with this idea. So, you know, what is really in your mind driving the energy transition? Is it naive to think that the carbon market's doing it? And I'm going to ask, I'm loaded questions here. I'm going to give you a few, but is carbon market the key driver? Is it the declining cost of wind and solar? Is it ESG pressure? Maybe it's all of the above, but where does the actual carbon market fit into driving this kind of stuff, in your opinion?
Yeah, I mean, I think that's a great question. I would love to say it's all carbon. I'm not that naive, even as a carbon market analyst. I think it does, provided it's implemented well, which I think we would say in the EU it has been. It provides a robust piece of regulation which can support the decline in costs we have seen, for instance, in the power sector. So has it been the driver or the key driver of the LCOE chart that Patricio showed? Like, no, we've also had technological advancements, and we've had, you know, utilities take a bet on, you know, which technology is going to play out. But has it allowed, you know, utilities or compliance entities within the scheme to know that their bet will pay off in the long run by avoided carbon prices? For sure. And actually, I think this conversation around, is the carbon market a key instrument, is increasingly being discussed given the high prices. So I think we would say pre-2018, especially pre kind of 2014, no, it wasn't a massive driver. It wasn't even featuring on, you know, utilities' balance sheets. It was a pretty small line item. I think when we start to talk about the average prices being at 100 euros per tonne, this is when it becomes a significant driver.
Patricio, let's come over to you. Same question, maybe also, I mean, obviously gas is a factor in Europe. Is, you know, what are you seeing as the key drivers of why Enel, Ørsted, and so forth are making the kinds of investments they're making?
Yeah, I think, well, yeah, without trying to repeat too much, I think it's a combination of the things, of the things that Emma mentioned, and carbon credits are obviously a part of it, because it's a direct tax on your emissions, so that increases your generation costs if you're doing it with gas or coal. And on the other side, or other hand, which is very compelling for utilities, is that by deploying wind and solar and batteries, what the companies want to do is sever their exposure or reduce their exposure to fossil fuel price volatility. So utilities tend to favor having sort of a hedged procurement on their power. So they want to make sure they know or that their power source is highly predictable in terms of price, so they can sell it forward to their customers at prices that are attractive and competitive. So from that sort of business case view, the fact that we expect that renewable power will be the cheapest power and with lower variable costs versus fossil fuels, I think that's sort of the argument for Ørsted and for others to keep pushing. And obviously there's, I guess the third component is the subsidies and the tax credits that particularly in the US, are I think helping the business case for them as well.
Sally, I want to come over to you. No carbon market really up and running in the Middle East, and I think ESG pressure is lower there, but I do think some of the names in your space in that region actually talk about some of this stuff. So how does it, what's the key sort of motivation out in that part of the world?
You're right. I mean, there's certainly less shareholder pressure, and I mean, some of the NOCs here have listed, or parts of their businesses have listed, and I think they are slowly catching up on kind of coming up with decarbonization plans, coming up with strategies. But I think generally for oil majors, you know, it is partly some shareholder pressure or just like policy pressure in general, not just in this region, but for oil majors globally, and just being conscious of the fact that, you know, these companies are some of the biggest emitters in the world. And I mean, to change that, and I mean, of course, they have varying and differing kind of projectiles for how they can bring those emissions down between now and 2050, or in the case of Middle East, by 2060. It would have to be by a change in product mix, and this is why we're seeing at different paces, we're seeing kind of strategies shifting towards different products away from oil and gas into low carbon businesses. And then, as I mentioned in my slides, kind of the capex profile slowly kind of shifting and kind of a bigger chunk of that capex profile being earmarked for transition-related things. And but again, I mean, I guess another part is just the belief that, you know, some of these businesses will be more profitable in the future. I mean, it may not look like it now, especially the last couple of years when oil is at elevated levels. I mean, now oil close to $100 a barrel, and the legacy oil and gas businesses looking very strong, looking very lucrative. It may not, I mean, the calculation there might not make too much sense, but I think the long-term vision and the long-term idea with these strategies is that, you know, these businesses become, you know, lower cost and just more profitable in the future.
Emma, I want to come back to you on an idea, kind of just hearing what Sally said. The carbon market's interesting. In Europe, you laid out a sort of long-term bullish scenario. I know you're about to update your view, but the trajectory, I assume, is sort of in place. And two things come to mind. One is, you know, what carbon price is the shadow carbon price to actually hit a net zero world? You kind of hear all kinds of ranges, but what's that high price that sort of on paper would be needed to get us down to this sort of kumbaya moment? And the second question is, you focus a lot on the European carbon market. It's the grandparent of European carbon markets. But are we going to see these expand globally? Is China going to get on board with it? Is US? Or is it going to remain sort of a niche regional type of instrument?
Yeah, both are great questions. I'm going to start with the global picture because I think the introduction of the carbon border adjustment mechanism, which kicks off in October, obviously it's just the reporting period before the kind of in earnest kickoff begins in 2026. This is kind of changing the game for international compliance markets. So if you're currently an exporter to the EU of pretty, you know, fossil intensive goods in, you know, steel, cement, the kind of covered sectors, this is really going to start hitting your balance sheet again. You know, if you're going to have to pay that EUA price, which by kind of from 2026 onwards, we're thinking will average, you know, around 100 kind of upward of that. Now, policymakers around the world have two choices in that respect. Kind of one is they just let the exporters pay that, you know, and they give that money to the EU and the EU cashes in. The alternative is you set up your own compliance market. So if you have your own compliance market and the price is equivalent to the European carbon market, you get to keep your own revenues and effectively you don't have to pay the EU anything. And so what we've seen, especially across APAC, is interest in compliance markets. How do we set them up? How do we make them robust? How do we avoid all of the pitfalls that the EU has, fallen into across the years? So, it began in 2005. We wouldn't say it's been an effective market, for a good kind of arguably 10 or more years of that time frame. So oversupply being kind of the big issue on that. So we are seeing compliance markets pop up. Indonesia recently, China obviously started theirs in 2021, but just the power sector, looking to expand to industrials, no trading though. So it's kind of, a slightly less exciting market for externals. The US, I mean, Rob, we don't have all day. The US is kind of its own kettle of fish. We have California, we've got Washington, New York's looking at setting one up. We've got RGGI, the Regional Greenhouse Gas Initiative. Will the US ever do a national market? I mean, it seems pretty unlikely, but you'd be better kind of placed to speak on that. I think this links into what price do you think we need? Because are we talking about a global price? Are we talking about a regional price? The EU price is effectively the price we think you need to get them to that 62% target by 2030. The IEA's tried to estimate it. We've seen a number of different studies trying to estimate what a global carbon price would need to be to achieve net zero. I think the biggest issue with these studies is what other factors do you take into account? So the IEA isn't one of the research houses who are saying there won't be other policies in play. So, but there are some scenarios, which is what is the carbon price for net zero if you just assume carbon markets are going to get you there? And they sit well into kind of the $500 to $1,000 per tonne. BNEF's not willing to give a global carbon price just yet, but I think it's a really interesting discussion around different mechanisms and how to get there.
Okay, very interesting. Patricio, I want to come over to you. You kind of heard commentary from the others, heard discussing views on where carbon markets are headed, and I'm curious to hear your sense on what the utility of the future looks like. I mean, how quickly are we going to get out of coal and gas in Europe? Is this something that can be done in the next decade, 2 decades? Because particularly in the utility space, that's the one where I think a lot of the policymakers see net zero occurring first. What time frame do you think is reasonable to really think about that outcome?
Okay, yeah, I think many things to tackle there, but maybe I'll start from the very end. Just to start, I think European utilities have more ambitious net zero targets than their counterparts in the US, and obviously more ambitious than the oil majors. Some of the companies are actually aiming to be carbon neutral by 2040 in scope 1 and 2, and some of them scope 1, 2, and 3 through 2050. So I think that's fairly ambitious, considering that the power sector is the heaviest emitter. And how credible is that? I think policy remains fairly supportive and sort of channeling that action. So I think one good example would be to talk about RWE, which is one of Germany's largest power producers and is also Europe's dirtiest power producer, because it has a large lignite and coal fleet. And through policy and through the government actually paying to auction off the closure of those coal sites, the company has set out an accelerated program to phase out coal from its operations by 2030. That's almost 8 years faster than it planned to do so a couple of years ago. And I think that's because the regulatory visibility is there. And on the other hand, the company is also planning to more than triple its renewable capacity by 2030. So if you put it out in a map, it's basically they're phasing out all the coal, replacing it with wind and solar, not only in Europe, but throughout sort of America and America as well. So the company is growing as well. And the company has also set out a fair amount of or let's say, a substantial amount of money to modernize its gas capacity. So that's a really good way, I think, of telling the energy transition story in Europe. Is are we going to phase out coal? It looks like we're going towards the right direction by all accounts in terms of investments and phase outs. I think that the open question in Europe will be how much will gas demand decline by 2030? If battery storage doesn't improve significantly over the next few years, I think that we won't have many options for dispatchable power, and I think that will leave the question for gas demand a bit open.
Okay, thank you, Patricio. So now I'm going to turn it over to our colleague Elena from the commercial team. She's been monitoring the chat. I think has a few additional questions that you've asked, and so we'll turn it over to her now.
That's great. Thank you very much, Rob. Yes, indeed, we have a couple of great questions here on the chat. So first one, how important is the offshore wind business to the likes of Vestas, General Electric, and other turbine suppliers?
Okay, I think that one's probably best for me.
Okay.
Look, I think we didn't really talk about wind when I had my turn at things. You know, I'm kind of skeptical that the offshore business matters much in the near term. You think about the investable time horizon, kind of 3 to 5 year range. As Patricio noted, the offshore projects take over 10 years to deliver. So I would argue that the offshore piece of the business is more about sort of the long-term trajectory of Vestas and competitors rather than kind of any near-term issue. I would point you out that we do have a focus idea on Vestas. Focus ideas are our highest conviction out of consensus calls, and we for a while have been making a scenario case that Vestas could do quite well from a EBITDA perspective, particularly if you look into 2024, not driven by the offshore business per se, but driven by a handful of other factors. One is that Vestas and all the peers really got caught off guard by the run-up in steel prices. And so that really hurt performance the last couple of years, if you know the wind space. But we've seen some really big changes that could help margin generation when you look to next year. And so, you know, what are those factors? One is that steel prices have actually come down quite a bit. That's good for the wind industry. Steel is a big component of their input costs. Two, wind folks have actually been raising their prices. So you got higher prices. That's a bit of a headwind for the utilities because they're on the other end of that equation, but it's good for the OEM. So you got higher prices, lower input costs, and you do have surging deliveries, albeit most of them happen to be onshore at the moment. So take a look at our focus idea on Vestas, and yeah, for now, wind is sort of like this thing, offshore wind at least is this thing off on the horizon. We'll see how it plays out. I'll turn it back over to you, Elena.
Great, thank you. Next question. What are the energy transition plans of some of the Middle Eastern national oil companies? I guess, Sadiq,
I can take this one. So yeah, I think when we look at the Middle East, I think Aramco is the company that we should be looking at. I mean, it's the largest oil producer in the world, and also, I mean, it is the only listed national oil company in the region. I mean, ADNOC in the UAE has listed some of its units and business segments, but Aramco is the one that has listed the whole company. When we look at them, I mean, I think I guess you could argue that they've been a little bit too slow, and I guess a little bit too late. I mean, it's never too late, I guess, but a little bit late to come up with the targets and all of that. And when you compare them to especially European majors, they may be a little bit behind. But at least now there's more transparency. There are some targets. And I think the backbone of their strategy is very much a shift towards petrochemicals, because we really had kind of two major paths for these majors. I mean, one is the renewable power generation, the change in the product mix, and then one that we're seeing with other companies like OMV, we're seeing with Aramco, a little bit with ADNOC, is a shift into petrochemicals, which would mainly be to tackle the Scope 3 emissions. And I think these companies see a lot of synergies in expanding further down the downstream value chain. So I think that's the main thing that they're doing, but I think it is, they have been talking about doing other things like their global peers. We know they have some investments in carbon capture. We know they've been talking about blue hydrogen, utilizing some of that carbon capture facilities. They have been talking about green hydrogen. Renewable power, I mean, it's not, I don't think we have set numbers for those, but we know that in the region, solar has a lot of potential. I mean, sunlight in the region is abundant, is predictable. So I think, and the good thing for Aramco the last couple of years, as I mentioned, for the rest of the peer group as well, they have been generating a lot of cash. So we know they're reinvesting more into their legacy businesses, but I think it leaves them a little bit more room to be kind of starting to look at alternative investments as well. So, so yeah, generally not as ambitious perhaps in terms of targets as European peers, but they are getting there, and they're definitely starting to talk a lot more about it these days.
Okay, great, great. Thank you very much, Salih. I think I had some technical issue at my room, and thank you very much to all the speakers for this great insights into the clean energy and decarbonization. Can you hear me well, by the way? Just to double check. Okay, great, because I've just had a quick issue. Great. Yeah, I just wanted to quickly show you a couple of things on the terminal, because basically we've discussed a lot about the research that we generate at our end at Bloomberg, focusing on clean energy, and you know, what we've been discussing now. Let me quickly share my screen and show you how to check those resources on the terminal. I'm sharing my screen now. Hopefully you can see that at your end. Okay, that's great. So basically what you can see at your end is the Bloomberg terminal panel, the command line. So we have Bloomberg Intelligence, which is our in-house research. And if you type in Bloomberg Intelligence, just as keywords, you can see under function suggestions BI. So BI is the shortcut, stands for Bloomberg Intelligence. If you click on BI, this will open this starting page, the dashboard, where you can see featured research, you know, key data, and so on. And on the left-hand side, there will be a tab, equity and industry. If you click here, there will be several options. One of them is energy, and if you go in energy, you will be able to check research and open pages for oil and gas and coal related research or renewable energy research. So this is something that comes with your terminal subscription. This is complimentary. You can use those tools and obviously check up research here for the topics that we've covered and discussed today. So speaking about our Bloomberg New Energy Finance research, how you can check up more details on that. If you run into the command line NEFW, which stands for Bloomberg NEF website, this will open a web page, again, with an overview on new energy finance tools, research and use, data, sectors that we cover, and so on. So this is something that you can leverage and take a look at. And if you have any questions, you know, you can reach out to myself, Emma, and we will be happy, you know, to clarify further. So maybe another thing that I really wanted to quickly share with you is end sub function, which is new subscription. So basically, this is the tool where you can look up news wraps or packages that we publish for our clients. And again, this comes with your terminal. And here on the top right, in the search toolbar, you can type in, for example, BNEF as a keyword, and then you can see all the wraps that have been filtered for that particular keyword. So you can find BNEF research or BNEF US power and gas research, and so on, and just scroll down to see what could be of an interest to you, and then you can see how often they're published, either monthly, weekly, daily, and then you can subscribe. Subscribe means here you will get a notification when content gets released, so you keep up up to date with what's coming out. So it's not something that you need to pay for. This is complementary again with our terminal subscription. And the same for Bloomberg Intelligence. So for example, if you type here Bloomberg Intelligence, and then hit enter. Okay, we don't have much here, but if you type in BI, for example, you can see some options. And then, for example, BI ESG, or just simply, type in keywords and play around with that. But I'm happy, to help you individually locate the content that you're looking for. Otherwise, BPS, which is Bloomberg Resource Center, again, this is the page where you can find all the resources we publish on the terminal. And then here on the left-hand side, you can see different tools for different either asset classes or the solutions that we offer to our clients. And you can see here tabs Bloomberg Intelligence and BNEF. So you can click into individual tab and then see all the brochures or one-page PDF files with some useful function links here. So what I'm going to do now after the call, I'm going to send you a quick overview and wrap with these function links that I have shown you. Also, we are going to send you the slides that we covered today and discussed during this webinar, and a replay link within 24 hours. So you will have this and you will be able to go over this content again. And again, feel free to reach out if you have any questions. I mean, you have my contact details. Otherwise, if you go on the starting page of the terminal, you can see my details here and also the details of your relationship manager. Feel free to reach out anytime, and yeah, we're here to support you, to talk you through what's of interest. And it was really nice to have everyone here on board. Thank you very much for your great questions. Thank you very much to our great global speakers and our team from Bloomberg Intelligence and Bloomberg New Energy Finance. That was great to have you on the call. And yeah, looking forward to having everyone either in a separate meeting or in another discussion or webinar later on. I wish you a very nice day ahead, or evening, and then speak to you later. Thank you very much. Thanks, everyone. Bye-bye.